Stock buybacks. The secret move that's pumping your 401k. Apple just spent $110 billion buying its own stock. Microsoft followed with $60 billion. And here's the crazy part. This money could have gone to developing new products, raising your salary, or paying dividends. But instead, these trillion-dollar companies are basically buying their own shares back from the market. So what's actually happening here? And should you care as an investor? Stick around because the answer might shock you. Hey, welcome back. If you're new here, we break down confusing money stuff into actual English. So hit that subscribe button right now because once you understand buybacks, you'll start noticing them everywhere in the stock market. Let me break down exactly what a stock buyback is, because the name actually tells you everything. Here's the scenario. You own a small business worth $1 million with you and 9 other owners. Each of you owns 10%. Now imagine your business makes $1 million in profit this year. You've got options. You could split that profit equally among all 10 owners. That's a dividend. You could invest it back into the business. Or, and this is where buybacks come in, you could use that $1 million to buy back shares from some of the owners. Let's say you use that $1 million to buy back the shares from one owner completely. Now there are only 9 owners. And you still own the same 10% you owned before. But here's what changed. Your share of future profits just went up. Instead of splitting profits 10 ways, they split 9 ways. Your 10% slice is now a bigger piece of the total pie. That's the entire point of a buyback. Apple is doing this exact thing, but at insane scale. When Apple buys back its own shares, they're reducing the total number of shares outstanding. If they had 10 billion shares before and they buy back 1 billion shares, now there are 9 billion shares. Every remaining shareholder owns a bigger percentage of Apple without buying a single additional share. It's automatic dilution reversal. Now here's why companies love buybacks. They instantly improve a key metric called earnings per share, or EPS. Let's use real numbers. Say a company earns $100 million in profit and has 100 million shares outstanding. That's $1 per share in earnings. Now that company buys back 20 million shares. Same 100 million in profit, but now only 80 million shares. Boom. That's now $1.25 per share. The company didn't make more money. Earnings didn't actually grow, but the per share number jumped 25% just because there are fewer shares. Why does this matter? Because executives often get paid in stock options and bonuses tied to EPS growth. If EPS jumps 25%, they win. Their stock price typically follows. So shareholders win too. But here's the problem. This is financial engineering, not actual business improvement. Think about it this way. If you're investing in a Roth IRA through Fidelity or buying index funds through Robinhood, you own pieces of these companies. You want them spending money on innovation, better products, higher wages for employees, things that actually create long-term value. A buyback doesn't create value. It redistributes it. But, and this is important, buybacks aren't always bad. If a company is mature, meaning they're already dominating their market and don't have amazing growth opportunities, buybacks make sense. Microsoft returning capital to shareholders through buybacks when they've already built an empire. That's reasonable. It's better than sitting on cash or making stupid acquisitions. The problem is context. During the pandemic, some companies took government bailouts while buying back their own stock. That's wild. Other companies buy back shares while their employees are underpaid and infrastructure is crumbling. That's a bad signal about management priorities. Here's what you should actually do with this information. When you're researching a stock, check if the company is doing buybacks. It's easy. Go to their investor relations page or any financial site. If they are, ask yourself, Is this company mature with limited growth? Are they returning excess cash to shareholders in a reasonable way? Or are they artificially pumping EPS numbers while neglecting actual business health? If you're investing in index funds through your 401k, whether that's the S&P 500 or a target date fund, you own pieces of thousands of companies doing buybacks. You don't need to obsess about each one individually. The market sorts this out over time. But if you're picking individual stocks, understand the difference between companies that grow through innovation and companies that grow their share price through financial engineering. Stock buybacks are real. They're everywhere. And now you understand exactly what they are. They're not evil. They're not magic. They're just a tool companies use to manage capital. And sometimes that tool is used well. And sometimes it's used to distract investors from actual problems. If this made sense and you want more personal finance breakdowns that don't waste your time, subscribe right now. We upload new videos every single week breaking down money stuff that actually matters for your future. Drop a comment telling me what company's buyback surprised you most. Thanks for watching, and I'll see you in the next one.